I'm having really good supply growth. I'm having muted material intensity in terms of the economy growth. And yet at best I get is a balanced market. And that's really what sets the stage is I have really low inventories. I'm balanced. I'm walking a tightrope here. Okay. Is you get a little bit better demand. You get some greater supply interruptions, even that we're already modeling, and it's off to the races. The answer is secularly, structurally, medium to long term. We remain very positive, copper, because there's two forces that are so far, unstopping, and that is continued impediments to net new production growth. There's all sorts of aspects that are preventing material net supply additions. And then the second part is the structural rising intensity of copper usage by our society in different aspects, electrical data, but then all the different aspects that are happening on the supply and demand side tied to power production, transportation, logistics, and then use. And so those are, in our society, is becoming more copper intensive. When we spoke, I talked about a rising intensity of usage per unit of GDP. And so while GDP has been weaker here than trend for a number of different reasons, whether energy or geopolitical or pandemic related, that intensity continues to be there, and that structural issue on growing supply materially, even with an incentive price, remains there. And so we remain positive there, while at the same point, Raoul, we do not have a material deficit in our balance sheets for 2023 and 2024 unless the world really accelerates. And so if China changes the nature of its stimulus versus what they've stated it's going to be for this year and going forward, or if the US and Europe reaccelerate faster out of this interest rate and energy-driven slowdown, then our balance sheet could change. But as we're modeling today, that is not true.
Let's talk about the supply and demand dynamics for now, this period that we're talking about, and then we'll get your big picture view, because a lot of people won't have seen it or need to be reminded, and you've done an extraordinary amount of work on this as ever, so it's always interesting to hear from people. So talk to me about the 2023-24, where the issue lies with the supply and demand right now that makes you just cautious around these levels still.
Well, the issue is that we, even despite the impact to material supply additions and the interruptions that we've had, we still have a decent amount of supply growth coming on this year and next year. So, we're averaging, the high 2%, whether it's 2.6, 2.8% over the 2 years of supply growth for China. And you're also getting some addition of scrap supply back, in that for a number of issues, to a large degree tied to China and how they handled COVID, you had a material impact to supply availability. And so even though we have China's demand coming back 3.5% this year for copper, it's not stronger. Normally you bounce back even stronger. Their fixed asset investment due to the government and industrial investment is actually going to be a lower rate year on year than what you saw last year. A good amount of what they at the moment are doing to stimulate is going into different aspects of healthcare and elderly, and aspects that aren't as metal intensive. And also due to the issues they've had with their property sector, the aspect of completions in terms of property, which is when you really use copper, is actually going to be lower. So in an overall nature of GDP for China specifically, they have a little bit of an inventory built up in both concentrates and scrap because of the nature of their events and how logistics was constrained. Their economy was restrained over the last 2 years. And the nature of how they're choosing to stimulate and bring that growth back, and the lagged nature of what happened in property, means more muted physical metal demand out of the single biggest demand driver for copper, which is China. And then the aspect for the United States and Europe, with the lagged effect of the energy-driven slowdown or recession in Europe, we'll see in terms of how you define it. In the US, housing is going to be down in terms of starts, auto production is going to be down. And so the metal intensity for what we're seeing for the world is a little bit weaker than it would be in an average recovery time period. And with the lag effect of certain supply projects coming on, brownfield and greenfield, we actually have a decent balance for this year and next year, where there's effectively no material surplus or deficit as we see it today. But I'm having really good supply growth. I'm having muted material intensity in terms of the economy growth. And yet at best I get is a balanced market. And that's really what sets the stage is I have really low inventories. I'm balanced. I'm walking a tightrope here. Okay. Is you get a little bit better demand. You get some greater supply interruptions, even though we're already modeling, and it's off to the races because this is the peak in supply growth in the next 5 years. And yet I get to balance basically, that's the aspect that's really creating the forecast that we have that copper price is going to have to go to a level to force substitution, force thrifting, force demand destruction.
How I like to look at these things is I overlay the business cycle framework. And what you're basically saying to me is, look, the business cycle is sluggish wherever we are, whether it's recession or whatever, it's still sluggish. Trend rate of GDP is going to be low and trending lower for a time being. But when we come out of the business cycle, once we've had some monetary stimulus and the usual cowbell that comes back into the markets, then we're setting up for something different.
Yep, explosive.
Yeah, and that makes sense to me. I kind of see it in the charts. I see it in the I look at copper year on year versus the ISM survey and forward-looking stuff. And, it looks like year on year it should start picking up. But because it's still relatively negative, things don't grow very quickly. It takes a bit of time to get traction. So, yeah, it does feel like it's slightly delayed, but we'll start to see recovery, meaningful price action, 6 months, 12 months out, and then things change. So
and then we should see a new record price for copper.
Yeah.
At that time.
Now, this is what gets really interesting to me. Let's talk about the EU, because they are probably one of the biggest structural drivers of the green transition, right? It's mandated. They've got carbon, the whole carbon allowances system. They're going to push this regardless. And, everyone said, well, you're going to end up with shortage of metal, shortage potentially of energy whilst you're doing that transition. How are you thinking through the big EU story here and how this plays into copper?
Yeah. So the aspect of different aspects of copper intensity and carbon, right, is aspects of, okay, you use 23 kilograms, if we're doing it for the EU, of copper per car in a conventional car, combustion engine. In a hybrid car, in a battery electrical vehicle, it's 83 kilograms. Okay, so you're talking 3.5 times as much copper per car to go from a normal combustion engine to a pure BEV. Okay, if I take a look at sort of, tons of copper per megawatt as I go to wind, I use 5.4 tons of copper per megawatt. Okay, if I go offshore, I use 15 tons of copper per megawatt. Okay, and when you take a look at that intensity versus a coal plant, okay, which is replacing, or natural gas or the like, you're talking, sort of multiples per megawatt with it, more than 5 or 15, because you use less than 1 ton of copper per megawatt in old conventional power. So whether it's the power production side, okay, or the consumption side, we're using much more copper intensity. And then you get into different aspects, which are interesting nuances, and that is that to replace baseload power, which runs all the time, like a baseload coal or nuke or natural gas plant, when I go to intermittent renewables, okay, I have to build more than 1 megawatt to replace 1 megawatt. So by our math, it's over 3 megawatts of renewable intermittent power and related storage that you have to build to replace 1 megawatt of baseload. Okay, so on an individual megawatt, it's massively more copper intensive, and I need to build more just because the intermittent nature of which, because it doesn't run all the time. Okay, so for me to get the exact same effect, including storage net for that, I have to build more than 3 times as much. So that's where you start to get into this geometric aspect of the copper density. Then you get into the grid, and also the fact that we've been set up as a society, to have these large centralized power generating entities that then go out. Now it's distributed, okay? And so we are talking millions of kilometers of incremental power wires that need to be built to make the grid and the distribution system as efficient as it needs to be. And so I'm creating not just power and demand for copper at the production side or at the consumption side, but I really need to build out massively my distribution network in the power grid. And that's, well, a good amount of that in the end will come from aluminum. There are aspects of it that are copper as well too. And so every aspect in terms of changing my supply demand function, one thing that you and I had spoken about before, normally when there's an innovation, a material change in commodity markets, it's either coming from the demand or the supply side. For us to be changing both, I'm changing the nature of my production system, and you're changing two aspects, which I don't think people fully appreciate on the demand side into power. And that is the U.S. has basically not grown power demand for 2 decades. Okay? We finally are getting power demand growth, but it's not really from the electrical vehicles, because everything else that we're doing on efficiency and the like isn't really creating material net demand growth. It's the adding of electrical vehicles and everything we're doing on data. The aspect of what we're doing in terms of data movement flows and maintaining 3G and 4G and 5G networks and that intensity, that is a massive growth in terms of power, okay? And so for the very first time in decades, we're actually getting net power demand growth in the United States from data and what we're doing on the transportation side. Either one we could probably handle, the two combined are creating a strain to the system.
We hope you enjoyed the video. At Real Vision, we help you understand the complex world of finance, business, and the global economy with in-depth analysis from real experts. Join the revolution at realvision.com.